Hello, in today's video we're going to be looking at the SPX index and trading 0DTE index options for today's session, which is Monday, June 23rd, 2025. So over the weekend, of course, we had the bombing of the Iran nuclear sites, and we also had some other news as far as affecting the markets as far as oil prices and the Strait of Hormuz possibly being closed, and other reasons for extended volatility for today's session. So going into today's session, we were expecting heightened volatility, and that's exactly what we got. Okay, so to start off with, this of course is the main CBOE XPX index. Our day trading GPS daily key levels indicator for XPX works on two different symbols. So the symbol we have it on now, which is the main XPX CBOE index, and also the SPX 500, which is this chart, which is the 8-cap CFD. So at 9 a.m., which is this, we'll go ahead and mark this off here. Okay, so on the CFD trades overnight like futures does. And so the reason that the indicator works on two different charts is by having it on this chart as well, you were able to get the levels for the main CBOE XPX index that doesn't open until 9:30 a.m. Eastern at 9 o'clock. So at 9 a.m., you will get both the levels for the 8-cap CFD, which is that's represented by these levels here, and this table here, which you can see here, SPX 500. Then you also get an additional table here, which is the CBOE XPX main index. So this gives you a 30-minute head start on levels for the XPX 30 minutes before it opens. It gives you a chance to do some planning and take a look at what type of option plays you might be looking at this session based on these levels. Then at 9:30, on the first tick of the SPX CBOE index, you will get the same levels here. This is an optional table which you can turn off if you don't want it on, and you will get the levels over here for the main SPX index. And as you can see here, these levels are exactly the same as the levels given at 9 a.m. on this chart. So we recommend that you use this SPX key levels indicator on a dual chart system, where you have this before the open, so you can actually get an idea of what the levels are going to be. It also gives you a chance to see those levels in relationship to previous couple of days price action if you go ahead and put it on a longer chart, say like a 15 or 30 minute chart. But for day trading, typically I will have it on either a 1 minute, 2 minute, or a 5 minute chart. Most of the time a 2 minute chart for the CBOE index. Of course, if you prefer to use a 1 minute or 5 minute chart, that's up to you. But I happen to prefer a 2 minute chart. Okay, so here we have the 9:30 a.m. opening candle here for today's session. As you can see, it opened up below the bull bear key price level for today for XPX, which was 59.7066. And just to go over these levels here, for those unfamiliar with this indicator, these are your midpoint levels. These are optional to turn on, but they can be very useful as far as gauging continuing momentum from one main level to the next. And they're also useful for stop losses on entries. And so basically, above the bull bear key price level is bullish and below it is bearish. So you can look at these R levels above it as take profit levels for bullish plays, and then for bearish plays the S levels below would be take profit levels as below. But do keep in mind that you can also take entries on S levels or R levels as well, just depending on what is happening at the price action at those levels at the time during the session, and of course where we are in the session in relationship to how much time is left in the session as well, because when you're trading 0DTE options, those will expire at 4 p.m. So you always have to be cognizant of that when managing your trades or initiating any trades throughout the session. Okay, so first off here, like we said, here's the 9:30 a.m. opening candle, and we have this bearish candle down, and then we have this reversal candle here off the mid BBKPL S1. So BBKPL stands for bull bear key price level. So down here it's just abbreviated to BBKPL. Alright, and so then we saw this explosive move through the bull bear key price level. So this was the first long entry here. So this is on the 936 candle here. And of course the way that TradingView does its candles, so the beginning of the candle is 936 and the end of this 2-minute candle is 938. So this is on the 936 candle. We have a nice explosive move up and a close near the high of the candle. So in this case we're going to be taking an entry off of this candle here, a long entry. Most of the time I'm taking entries at an at the money strike on the level that I'm taking the entry at, or the strike closest to the level that I'm taking the entry at. So in this case this would be the 59.70 call, but I know that some people like to do out of the money options as well. So we're going to go through those examples as well. I'm also going to show you the option charts for each one of these on Thinkorswim, so you can see and validate these different prices that we're using for entries and exits. But for right now, 59.70 call entry at the 936 candle. The best price through this candle was 13.20, and the highest price within this candle was 18.09. So we're going to be looking at just basing these trades off of one SPX option contract per trade. However, I know that there are a lot of you that will do, we're looking at that for just purposes of what the minimum profit would have been just using one option contract, which is over here, which the total was $2,679 for the day off of these two option trades, also based on the worst case price scenarios for both buys and sells, which I'll go through here in a second. So obviously these price ranges here, that's the low and high that you could have got it for. And so in our examples of showing how much profit that these represent, these two option plays represent today, we're going to use the worst case scenario. So in this case scenario, we're going to use a buy price of 18.09. However, a lot of you would have gotten a better price than that, but I think it's better just to go ahead and use the worst case scenario. Okay, so that's an at the money call based on the bull bear price key price level of 59.70. But as I mentioned earlier, if you're more of a kind of trader that wants to do out of the money calls, then you would take the out of the money calls strikes based on the R1 or R2 levels. So the R1 level here is 59.85.35. So if you wanted to instead buy an out of the money call option here, since we are very early in the session, that's certainly very viable this early in the session to do that. And here that would have been a 59.85 call, and the range on that would have been 630 to 970. So that's $630 to $970 per contract. Or you could do a 6,000 call based on the R2 level, and the price within this candle was $255 to $430, so that's $255 to $430 for one contract. The stop loss on the entry, there's two different examples of stop losses here because some people like a tighter stop loss, so I'm going to give you what the standard stop loss and the tight stop loss is. So a tight stop loss with this kind of entry would be a quarter level below the bull bear key price level, and that is 5966.99. Now we only have the midpoint levels here, so if you wanted to do a quarter level anywhere here, what you simply do is take the main level and the midpoint level and add those two together, divide it by 2, and that would be 59699. Now, instead of a tight stop loss, if you wanted to use a standard stop loss, that would be a half level below the entry. So that would be the standard stop loss for this entry would be the mid BBKPL S1, which is 596332, which you can see over here. As you can see here, there was no retrace. The SPX basically just kept going up. Had a few stutter sideways steps, but stair stepped up all the way eventually to R2. And generally, my style of trading is that I prefer to look for moves that are, as far as exits, the minimum is going to be one level move. But as you can see here, if you got in at the end of this candle, it is nearing the midpoint level here, so it's almost at the quarter level point here. And so really a one level move would be about here, 1.5 or 2 level move up here. Okay, so you have the both stop losses here. Those were never in question here. But here at 9:52 a.m. you have SPX hitting R1 5985.35. The 5970 call is now 2130 to 2490. The 5985 call is 1180 to 1460, and the 6000 call is now $5.43 to $6.90. And at on the 10:04 candle, SPX hit R2, which is right here, of 6,000.04. So normally what you'd want to do here is you would want to close out. This is basically a 2-level run. If you are trading one contract, that's your only choice because you can't leave a runner on one contract. It's either you have to just get out of the one. But if you're trading multiple contracts, let's say you were trading 5 contracts or 10 contracts, then if you don't want to get out of all the contracts here and you want to leave a runner and adjust your stop loss, then you would only leave a 10% to 20% runner with an adjusted stop loss. And the suggested adjusted stop loss, if you're going to do that, would be to the half level down from this level. So that would be mid R1, R2 at 59927. Okay, so for example, if you had 5 contracts and you sold 4 of them here, that leaves you with 1 contract, which is 20% of your 5. If you had 10 contracts and you sold 8, that would leave you with 2, which is 20%, or if you had 10 contracts and sold 9 of them, that leaves you with 10, just to give you an idea. If you're trading kind of odd numbers, like you only have 2 contracts or 3 contracts, then it's really just best just to close out all of them. So runners are really better if you're trading, say, 5 contracts or more, 5 contracts to 10, or some people like to trade 20 lots. It just really needs to be a lot more than 1, 2, or 3. Okay, so going to this over here, which we're showing the profits for one contract based on worst case scenario prices. Right down here, we had the worst case scenario entry was 1809. And here, the worst case sell price, the range was 30.88 to 34.60. So we have 30.88. So we subtract those two, and basically you have $1,279 profit before commissions. Now obviously you could have gotten a better price down here than 1809, and you could have sold at a better price up here than 30.88. But we're just going to look at the worst case scenario just to look at the minimum profit. Okay, so here we're starting to go sideways. This is a very important level. 6,000 is a big number. So this is a big test here. Also on days like today, with still the uncertainty in the air as far as any retaliation by Iran and some other things going on in the markets. You know, and also if we look back on the previous sessions, which we can't really do here on this particular chart because it's only a 2-minute chart, but if you look back on previous sessions, this was a very important area. So you know, it's going to be likely that we might see a retrace back down to see a test of the bull bear keep price level again, or even a retest of the open or of the low of the session so far. So here we're getting some sideways movement, and we're getting the first candle close below this R2 6,000 very important level. So this would be the 6,000 put entry here, and at that time it's 10:28 a.m. So the range in this candle for that 6,000 put is 1110 to 1330. So that's $1,110 to $1,330 per contract. But you could have also entered anywhere from the beginning here at 1028 all the way to 1046, which is this candle here, as we did see a little up and down chop movement here. Here in this candle here we had a move where it tried to go above again and failed, and then we have finally this confirmation of the down move again here. But in any event, the entry, at least my entry, is here at the 1028 candle. This tight stop loss on this is a quarter level above R2, which is 6,738. Again, how we get that is we simply just take the R2 level, the main level, 6,004, and the 6,014.73. Add those two together, divide it by 2, and that's the number that you get, 6,738. So this is your tight stop loss level. This would be your standard stop loss level for this entry here, which is the mid R2, R3 of 6,014.73. So here, approximately an hour and 12 minutes later, we have at 11:40 a.m. SPX hits R1 at 59.8535. The 6,000 put is now 1730 to 2188. Okay, and then we get a continuation move here after we had looked like it was going to try to pop back up, but then we got a nice encompassing red candle of that one here. It tried again and failed, and then it started moving down again throughout this series of candles here. So this was 11:40, and then at 12:24 p.m., which is 54 minutes later, SPX hits the bull bear key price level here on this candle here at 12:24 p.m. at 59.7066. So as you can see here, there's sort of a waterfall effect where the candles, at least here, this one's larger than this one, and this one is larger than this one, and it closes below it. So again, here you have a 2-level move. So you would close out all your contracts here unless you had enough to consider doing a runner of 10 to 20%, as we talked about earlier. If you did leave a runner, then you would have placed your stop loss here, adjusted stop loss on the runner at the mid BBKPL R1 of 59.7801. We did get a further move down here, and we had this little tail of this candle here, and then also one here. So the final move went all the way down to 59.43 and change down there. But at 12:34 p.m., SPX hits. Well, let's go back to this for a second. Here, where it hits the bull bear key price level, the 6,000 put is now 27.30 to 32.19. So that's where you would have closed out at. If you did happen to leave a 10 to 20% runner, then you had these opportunities here, both here at S1, and then it did spike through very briefly the mid S1, S2 at 59.48.63. So at 12:34, it hit S1 59.55.97, 6,000 put now 42.14 to 50.59. Okay, so going over here, that completed our second option play of the day. And of course, we're going to use the worst case scenario. So the worst case scenario up here was a buy price of 13.30. The worst case sell scenario here, when it hit bull bear key price level, 27.30. So 13.30 to 27.30 is 1,400. So the total for these two plays is $2,679 before commissions. Now here we have this very long tail candle here. So this oftentimes will be a prelude to a reversal move. In this case, on this particular session, it was. And so the point of this comment here was not specifically to do another play, but if inclined, sorry for the typo here. If inclined, you can use a small fraction of earlier profits for a cheap lotto call buy here. So this is starting at the 12:36 candle, 12:38, and then we have the 12:40 candle. And then we have the 12:42 candle. So just keep that in mind when I'm showing you the Thinkorswim charts. So the idea here is you're already up, if you're just trading one contract, you're already up $2,679. So when we're getting to this point here, you'd want to take a look at some out of the money cheap call options for a return back to these levels up here for it to test that, because a lot of times you'll get these V-shaped moves where you'll get a deep drop, you get this kind of candle, then you'll get this V move back up to test this, and it may fall off again after that, but going back up to try to test the range that it was at earlier. That happens quite often in the SPX. It's not going to happen every time, but the point is that if you have a cheap enough option up here where you can take a very minimal amount of risk, you could, because remember, this is still only about, in the 12:30 range right here. So we have 3.5 hours to go. And so if you have a cheap enough option play up here, you could take a couple $100 of this $2,679 profit for a lotto play on one or two options that are cheap for the see if it will return back up here. Now in this particular day, on this particular session, that happened to work out quite well, as you'll see. And but keep in mind, none of that is considered over here. These are the profits for these two option plays over here that we did. And this is just showing you when you built up profits like this, that later in the session you can take a chance on a lotto if you have reason to do so based on the price action and the chart. Okay. So if you did do that here, if you were buying an option cheap enough, like say you were buying an option that was $1 or $2, you could either go into it with an expect zero stop loss on this lotto option, meaning you're just going to let it ride. You've already got $2,679 of profit. If you took a couple $100 of this, basically 10% of it, to put towards a lotto play, you could basically either do an expect zero stop loss, which is no stop loss, and just let it ride and see where it goes the rest of the day, and just keep your other profits intact and closed out. If you did buy a more expensive option and you bought something that was closer to at the money, which is not really the point of doing the lotto call. But if you did that instead, then you would want to put your stop level at the next main level below where the tail of this wick is here. So that would be the S2 59.41.28. So price comes down and touches this, you would be out. That's mainly if you're doing an option play that's more in this range here, strikes, versus option plays that are more in the R1 to R2 range. Okay, so with that in mind, let's take a look at some of these different plays here. So we'll start off with excuse me. The 59.70 call option. Okay, so as we said here, let's go back to here. We had a 936 entry candle. 936 entry candle on this 59.70 at the money call is here. Here's our range. So you can see here the high 1809. Here's where it hits R2 at 9:52 p.m. It's this candle here. Here's where it where it hits R1. Here's where it hits R2 here at 10:04 a.m. This candle here. Now let's go to the 59.85 call option. So if you were taking more of the out of the money call option, it's going to cost less to begin with. Here's the entry at 9:36. This candle here. Here's where at 9:52 it hits R1. This candle here. And here's at 10:04 a.m. where it hits R2. This candle here. Next, we'll look at the 6,000 call option. So this was the cheapest of the call options. Here we have the entry candle at 9:36. As you can see here, we have a range from 255 to 430. Here's where at 9:52 it hits R1. Here at 10:04, this is where it hits R2 level of 6,000. As you can see, we have a range here from 970 to a high of 1280. Now, going back to the lotto play here we have the lotto play. So if you were doing if you were going to buy the 6,000 call options here, if we go back to this here, when it was down here in this area here, if you were going to do the cheap option lottos, here we had 55 cents. So you basically have these candles here, say these 4 candles here. So you have anywhere from 55 cents to about $1.33. So we could just surmise that you paid $1. So you could buy one option, you could buy 2 options. Like I said, you made $2,679 if you wanted to spend $100 or $200 or even up to 10% of that $2,679, $260. You could have even bought 2 here at $1.33. Now, this particular Thinkorswim chart was done earlier in the day. It was captured earlier in the day. So these actually ended up being higher than this, I believe, at the end of the day. But as you can see here, we go from, say, roughly $1 and we're up to $15. So you had plenty of places along the way that you could have gotten out, depending on how long you wanted to hold on to, or just to look at what happened. You could have just held on to it to the end of the day. If you did that, we have SPX going up here all the way almost to R3 at 602942. Looks like we got up for a high of day 602877. So we came about 60 cents short of our 3 at the close. So basically, you know, if this was a 6,000 call, this would have been worth up to say $28, $29. And you certainly had plenty of opportunity where you could have gotten out higher than $20 because you had these last several candles here. So as you can see there, when you do build up profits earlier in the session, you can take chances at the end of the session or at midway through the session if you want to see a possible reversal of the index based on what's going on in the market and the price action. If you feel there might be a reversal, or it doesn't necessarily even need to be a reversal, it could be a continuation move where let's say it popped up and you thought that it was going to be to the downside, where you could have bought in way out of the money puts if you thought it was going to be a move to the downside and this was just simply a fake out. But the main point is that you're only taking a small fraction of the profits that you've already closed out early in the session on a lotto play. Okay, so let's take a look at the 6,000 put. Which is the final one here. So going back to the 6,000 put, remember the entry was at 1028. Okay, so we have the 1028 to 1030 candle here. Then we have at 1140, SPX hits R1. Then we have at 12:24 p.m. where it hits the bull bear key price level again. And that would be where you would close out everything. And then if you did leave runners, here's where it hits S1 at 59:55.97 at 12:34 p.m. So just going back to this here, 1028 to 1030 candle for the entry. However, you could have gotten in, as I pointed out here, 1028 through 1046 at relatively the same price. If we go back and look at this, that's what this rectangle is here. This year the pricing was basically the same range here throughout that time period. Then we have the 1140 hit here of R1, and then the 1224 hit here of the bull bear key price level, and then the 1231 S1 hit. Okay, so that's going to do it for this session. As we talked about earlier, these prices here were based on the worst case scenario of trading one contract, buying at the worst price here, selling at the worst price here at the 2-level move. Same thing with the SPX 6,000 put option, buying at the worst case scenario price here, selling at the worst case scenario price here when we have the 2-level move. The total for one contract $26.79 before commissions. So if you were trading 5 contracts, that would have been $13,000. If you were trading 10 contracts, then that would have been $26,790. So you can imagine, you know, if you were up $26,000 and you wanted to use a small fraction of that here, like $1,000 of that $26,000 here, then you had the potential to make another $25,000 to $30,000 just with a $1,000 buy down here. So that's why in your trading process, if you make sufficient profits, if you make a couple $1,000s of profits earlier on in the session, that's always a possibility that you can do a lotto play later on the session using a small fraction of your winnings from being closed out earlier in the session. Okay, so in the description under the video, we have some more information about our day trading GPS S&P 500 SPX Index Daily Key Levels Indicator. I hope that you take a look at it. We have a monthly subscription available, as well as a one payment for lifetime access subscription. Also, this indicator is part of our Gold Indicator Suite, which includes 8 different indicators. So you can either buy this S&P 500 SPX indicator by itself, or if you also trade other stuff like stocks, ETFs, Forex, crypto, futures, etc., then also take a look at our Gold Indicator Suite. Okay, well, thank you for watching this video. I hope you like and subscribe to our channel, and we appreciate your time. Thank you.